Hey, good evening, stock investors, and welcome to my live stream. We are going to look at some stocks this evening and do some analysis of those stocks. If you're new to my channel, I look at stocks and try to find an intrinsic value of those stocks by looking at a forecast for those cash flows that the company is going to produce and try to find a net present value of those cash flows in today's value and compare it to the stock price. I also look at the future profits represented in earnings per share and try to drive to an intrinsic value that way as well. And try to see, what is that stock worth? If we just measure a business based on the profit, the cash flow it's going to produce, what's it worth? And then compare it to the stock price. So that's primarily what I do on these live streams. And I welcome you to put a stock in the chat and that you want me to look at. If you are a member, you know that those requests come at no additional fee. I appreciate people being members of my channel. If you're not a member, no big deal. Just a $5 super chat and you're in and you're on the list for me to look at that stock. Taking a look at the market, it was a positive day. The market is dealing with a little bit of news, right? We've got a government shutdown. And that's not weighing all that much on the stock market. The stock market kind of brushed that off and said, big deal, no problem. NVIDIA was up and Broadcom was up, Apple was up. Meta was up nicely. Meta had been down for a few days and now it's picked itself up. I heard some interesting news that Meta is introducing Meta AI for business. And one of the ideas is the Meta glasses they put out that have cameras. They see a lot of use cases where employees could be wearing them. Think about a retailer that an employee could check inventory very quickly by speaking to its, to the device. Your glasses are a device tethered to your Wi-Fi and is basically a new device from which to operate with. Now, of course, employees currently have handhelds. That's fine. But what if you had glasses instead and you would then be able to have both hands free to do whatever you need to do at your job? Or what if you had to capture a quick video? Let's say somebody's shoplifting in a retailer. You can video the situation very easily, or other situations that require video. So there's just a lot of use cases there. I thought it was really interesting that Meta rolled that out and rolled out some of the ideas they have there. Amazon was up. Amazon too haven't been having the greatest of years. Let me go to the year to date and show you what I mean. Amazon's just barely up 1.38%. While the market's up 14% already. And some of its peers, and I consider peers of Amazon, these big market caps, like Google's up almost 30%, Meta's up 24%, Microsoft 22%, NVIDIA up 40%, Broadcom. So Amazon hasn't kept up with its peers. And I think it's an opportunity. The market at times will get caught up in a story that, oh, this business isn't good anymore. Let's not buy it anymore, and so forth. It reminds me of United Healthcare. United Healthcare has been doing great. For the last 2 months, it's been going up, and I think it's going to keep going up. We'll see how it goes. So the market just continued to go higher. It went up mostly on the NASDAQ and the Russell. We saw both of those indexes go up substantially. The Russell going up 0.66 and then the NASDAQ up 3.39. But it was green. So we're 2 days into October and we are in the green already, which is good. Now, October could come with some volatility. So let's not be overly surprised if we see some stocks really start to sell off. I happen to think, sell-offs are somewhat healthy. If we just keep going higher and higher, it just means if we have a correction, it's going to be harsher. So I'll take either one. If stocks continue to go up, I win. If stocks really sell off and offer up an opportunity similar to the one in 2022, I'll buy stocks that I really want to own, companies that I want to buy more shares of, and I win. So I'm trying to create a win-win scenario for myself. I am carrying a little bit more cash than maybe I had at the beginning of the year, and I'm glad for it. I'll just have that cash around in case we have a nice sell-off. Looks like Brandon is in. How are you, sir? You want to look at PSIX. And I am glad to look at PSIX. I have what looks like 5 stocks already requested, believe it or not. The jukebox already has quarters in it, if you know what I'm talking about. So just bear with me, Brandon. I'm going to get to PSIX. It's number 6 on the list. So the markets are up. They're up nice and high. And for the remainder of the week, I don't think we have any big news. And for the remainder of the month, I think we're going to hang tight until we get earnings beginning to be announced. And that's going to happen roughly in about 2 weeks. We're going to see the initial earnings releases coming out. The early companies that announce will start, and then we won't stop for like a month and a half, 2 months. It'll just be a very, very fast pace of earnings. And the real big ones, like the big market cap companies, a lot of them will announce in roughly about 1 month. And we're going to see the market move on that news. Looks like Zen. What about Duo? I think you're talking about Duolingo. Happy to look at that. Just put in a $5 super chat or become a member. Then you can request these stocks to be analyzed. All right, guys. So as mentioned, we had some members email me and ask that I take a look at a couple stocks. And we're going to look at some stocks that are small caps and very interesting, with the exception of one. Airbus is not a small cap, and that's going to be one that we look at. So I think it's Nutex Health. This company, and I've got their website open, they own hospital locations or healthcare locations, and they own them across the country. They've been growing at a very quick pace. I'm going to show that in a minute. But I first wanted to kind of get my head around what are they doing? Well, they own 24 quality care facilities in 11 states, and they're going to add 10 more. So that is interesting that they're adding these facilities. All right. And now we're going to look at the company's just overall fundamentals, where their stock's been. For the 1 year, this stock's really moving. It's up 421%. Year to date, 238. Now, over the 5 year, it's interesting that this company came out for the last 5 years. Now, during COVID, it was kind of a rough time for hospitals. And then they got out of COVID and got back to normal, which was good. And this company, for some reason, it's a small cap. Its stock price really took off, got up to $1,500 a share. Wow. And it really came back down to $22 a share. So whoever bought, 4 years ago was probably hurting big time. But over the last year, it's gone from being a stock that's in the teens up to $107 a share. Really nice return for those investors who were in on this stock. It is a very small cap, $595 million of market cap. And the revenue for the business, $624 million. Now, these guys own real estate. They own properties. And it's not a high growth business, because in order to grow and sustain your growth, you're going to continue to buy properties. That may not be doable. You'd have to have a lot of capital, really probably get into a lot of debt. And it could be risky after a certain amount. Right now, they're small, and they have the advantage of, if you're small, you could probably pick areas that had good organic growth of population, and they really do need more hospitals, or medical facilities in that area. Hey, you know what? Nutex probably has an advantage there. They could set up these smaller hospitals, which is kind of their way of operating, and provide something that's needed by that community. So I think that has a really good place. When we look at the financials, we're seeing really fast growth, but this is growth because they're buying facilities and putting them on their portfolio. So it's a good thing. I think it's a good thing if they have a good idea going, but it's not like, let's say NVIDIA has such a good product that they get to sell the same product over and over again. It's just a different business altogether. They do have good gross profits. And if we look at what is their gross margin on product, on their sales, it's 51.95 on the trailing 12 months. They have had their profits kind of go up and down. It might have been that they were building a facility or they were just not profitable in 22, 23. That's interesting to see that. But now they're back to 52% gross margin. That's good. Profit margin 10.76 and the free cash flow yield of 11%. That is very good. All right. So one area that I'm curious about is their debt. A business like this probably has to carry a little bit of debt, and they certainly do. If you compare the total debt and deduct cash, we get to a net cash position of 256. That is at 1.5, well below 3. These guys have a good balance sheet. And it's a good balance sheet for two reasons. One, their debt is not over 3 times EBITDA, but they also have these properties they own on their balance sheet. So it's a good balance sheet that has assets in it. So that's why I think they have a very good balance sheet. We've got 2 analysts covering this stock, and they're both very, very high on the stock. One's at a $300 price target. The other one's at a $205 price target. Man, they only have 2 ratings, but boy, the 2 that they have are really good. And the guys who are putting those targets out there, they got 4 stars. So it's not like they don't have any credibility. They have some credibility. Now, here's what I wanted to really focus in on. This is the year that we are looking at. We're looking at fundamentals for 2025. It's going to end here in December 31st of 2025. And yeah, there is really good growth. And they on their website state that they're buying facilities, opening facilities, and that's what's driving their growth. But you look at 26 and we don't have any real growth to report. And that is the case with these types of companies is if you just have, it's the same location. If you looked at the same location and measured organic growth at that location, it would be single digit, like 2%, 4%, 5% on a good year. And that is not overly exciting. So that's one of the things that as an investor, I would be very cautious with is my expectation for growth going to be accurate? In this case here, I'm going to go with a low growth rate when it comes to the growth rate of my cash flows and the growth rate of my profits. So the profits are going to expand next year. Even though they don't grow, the profits are looking good, like they're going to expand. So this is a business. Now, what kind of investor would be buying this type of business? Well, since they're small, it's an investor that's willing to take on more risk because smaller companies are riskier. Surprises could come up. Bigger existing competitors could be a threat to these businesses, compete with greater scale, greater awareness, greater network powers that they have, and so forth. The investor also that would be interested in this type of business, since it is healthcare, these are healthcare facilities, I tend to think that this is an industry that's actually lower risk than, let's say, a company that's in robotics or some new technology that is unproven. The reason I say that is, of course, hospitals are something we need. We've needed hospitals for a long time. We know what a good hospital is all about. So the industry itself isn't overly risky. It's just the fact that this is a small company. So it's a combination. Maybe an investor that is looking for a good yield, a good growth out of a stock investment. At the same time, understands this industry, understands it's more of a stable industry. All right, so we went over the fundamentals. Let me show you the valuation that I already worked on before I started streaming. And I'm going to change a couple of things. After looking at it again, I wanted to change my growth rate on this particular earnings per share. So go ahead and do that. So this is a small company. They have a good balance sheet, but since they're small, I'm going to go with a higher discount rate, higher than 8%, because they're small. And I'm going to use their trailing 12 months to establish their cash forecast. I'm only going to grow by 6% over the first 4 years. Again, I saw that growth rate on their forecast, and I think that would be an adequate growth rate for the first 4 years. And then after that at 4%. Now, the intrinsic value of all those cash flows is $1.44 billion. I add cash, take away debt. So overall, the equity value I'm seeing in this business is $1.187 billion. Market cap's only $595. So there is a really nice discount. If I look at the cash flows that Nutex is going to produce, and if we look at earnings per share, analysts may be treating this as a growth stock and giving it a 24 PE or even a 36. Now, I'm not going to do that, because if they end up being a single digit grower in healthcare at the margins they have, 12 is the best I can do. And I'm going to be a little conservative, but it's because I'm investing my hard-earned money. So I'm going to go with the 12. I'm going to grow that by 15%. I think they could achieve that as they operate their business and get better at it. I think they can grow their profits. And I'm using next year's earnings per share, using 2026. And when I do that, I get a value of the stock based on its profits that is 42% below the current stock price. And when I combine the two and I blend free cash flow with the valuation based on earnings per share, profits, I come up with 34, because I use 2/3 of the free cash flow number, 1/3 of the earnings per share number. Now that's a neat discount. It's a good discount, but why am I hesitant? Well, the stock's really moved, and I think the market caught itself. It's like, wait a second, why are we buying this stock so at a feverish pitch? Now, they probably sold the stock off because they're concerned. They want to see more information. They want to see another earnings report. The next earnings is going to be November 6th, and they'll provide more information. So I would kind of be in the camp of, yeah, I'd like to see that earnings. That may show that, hey, they're actually doing better than I expected. Or maybe, hey, there's signs that they are going to begin to plateau. And if they plateau within this industry, I don't think their valuation is going to be all that exciting, and this stock may really sell off. So it's just a little too much risk for this investor to take on. We are in an expensive market, and I'm going to show you a couple of stocks that are coming up that really do tell me that the market's expensive, and you'll see what I mean. So that's Nutex. That was a request by a member, and I want to be sure I covered that. All right, we're going to move on to the next one. But before I do that, it looks like we've got a couple of other people on. Peyton, good to see you. Yeah, I agree that, our population in the U.S., it is getting older. And as you get older, you need more healthcare. Most definitely agree with that. And the other thing that I think is interesting about Nutex is they are moving to areas because I mean the population is growing in some regions and not growing in others. It's actually contracting in some regions. So building hospitals or opening hospitals or facilities in areas that are growing, that probably have a little more economic, uh, good times, good economy locally. That's a really good idea. So overall, I think it's an interesting business, but the stock has gone up quite a bit. And I don't want to be late to the party and then see my investment go down as a result. All right. So, Hassan, good to see you. Glad to look at CHH. If you buy a super chat or become a member, take a look. Take a look at the member program or buy a super chat. Ben 10, how you doing? Good to see you. Yeah, you've been taking a lot of risks this year. Well, risk takers have been making money this year, so I hope you're in that category of making lots of money. Kurt, great to see you. You would like to look at ORI. Yeah, we'll have plenty of time. Just I'm going to ask for a little bit of patience because, as mentioned, when I started streaming, I had a couple requests come in, and you are now like 5th or 6th on the list. So just bear with me. I'm going to get through the list as quickly as I can. Glad to cover it. We have plenty of time tonight. I'm going to turn on the football game in about 40 minutes so I can multitask. I'll watch the Rams and the Niners out of the corner of my eye, and I'll be analyzing on the two screens ahead of me here. All right. So we've got, I don't know about healthcare being a high risk area. I think healthcare tends to be lower risk. It's not as high risk as, let's say, you're going into a technology where you have hyper growth and a stock's really bid up, and then the growth stops, and then that stock really gets hit. Healthcare tends to be slower grower and more stability. Yeah, that hospital is going to be open for 20 years, 30 years. It's not going to go anywhere. So, yeah, it's interesting to look at. Big House, Juice, how are you, sir? Good to see you. Herdo, great to see you. Thanks for joining. We got a lot of members on the stream. Thanks, guys. Great to see all your names, and keep the requests coming. I'm going to try to go marathon tonight. I think I've got at least 2 hours in me. We'll see if we can go 3, especially if there's a football game on. So let's get into it. All right, we're one stock in, and we're going to keep moving along. Now, this stock is exciting. This is Richtech Robotics, symbol RR. These guys do robotics, and I'm going to show you their website in a bit. Now, I think it's a neat solution. When I looked at the company and saw what they're doing as a use case, right? They're delivering parts and so forth. If you look at the Amazon use of robots, Amazon's doing something similar, and they have over 1 million robots already in use in their warehouses. And these robots take these big racks of product from one location of the warehouse to another, where then an employee would pick, pack, and ship or sort and do more things as part of their supply chain. Now, this use case may not be a really popular one because I don't know how much advantages and efficiencies you're gaining from having this system. But hey, I think it's an idea. It's an idea. So let's take a look at the numbers. So we know the use case. Now let's take a look at the numbers. Now, the stock is up 568% over the 1 year. Holy smokes. 91% year to date. So the market's really excited about robotics and AI. And I think they're really neat. Let's take a look at the numbers, though. What I'm a biggest fan about is profit. You show me Meta's 85% gross margins and 20% growth rate on a giant number. I really get excited from the numbers perspective. Let's see if these numbers are good. The market cap is 829 million, but the revenue is only 4.13 million. So investors are having to pay 200 times revenue. It's very expensive. This business better grow like really, really fast, or I don't know what investors are buying here. They're losing money. That's not a showstopper. Losing money when you're a little company, that's a little bit acceptable, so long as you have a very good business with good margins and you're capturing a fair amount of the market, and you're going to be bigger at some point. So we'll take a look at that. They don't have any ratios here because they're not making money. Analysts think there's only a 16% discount left. As I look at their financials, I start to see problems. So the concept of these robotics that they're trying to sell to the market, it's not new. As mentioned, Amazon has over 1 million robots. And you think about, for how many years have we had these robots vacuuming our homes, right? You have these robots that learn your house and they go around your house pretty much vacuuming all the time. So this business should be growing, but it's not. A couple of years ago, there were 8.7 million in revenue, and now they're down to 4.13. That's a problem. Why aren't you growing? If you have an idea that the market likes, you should be able to sell more of it. And again, these guys, from a revenue standpoint, are tiny. 4 million. There's automobile dealerships that are much bigger than that from a revenue standpoint. There are stores that do more than 4 million in revenue, just one location. So not sure what what investors are excited about, frankly, because the scale of this business is tiny. It also shows me that, hey, it's not like some gigantic business is excited about this company's product and is buying, $500 million of product or something. So I'm seeing a big gap between the excitement in the stock, the emotion, and reality. It's a pretty harsh difference there. Now, the cost of revenue isn't too bad. They have a decent gross margin, but I can't get over this number. Let's carry on. So they're not producing any cash flow. Margins are good, but they have a long ways to go. And I think investors are taking a pretty big risk on this stock. No analysts are covering it. This stock is really tiny. Now they're expected to grow, and the growth percentage looks pretty exciting, but we're dealing with tiny numbers. I mean, these numbers in 3 years, actually 2.5 years, they're only going to be 18.5 billion. At that point, based on their market cap, you'd have to pay like 50 times revenue. That's way too high. So this one here is a solid pass. I don't own any shares. If I did, I would sell them immediately because there's just so much risk. And it leads me to kind of take this as a data point and just say that, we are in an expensive market. And when you get into a lot of examples like this, where, man, this stock's up 568% and it has $4 million of revenue, it shows that, to me, it's an example of a business that might be hyped up, very expensive, and at some point is really going to torture investors that are in the stock, the ones that got in at $4 or $5 a share, if it comes back down to $1 a share or something. So Richtech Robotics, I can't even do a valuation. There's no cash to evaluate. There's no profit to evaluate. But high level, this is not my cup of tea. So thank you to the investor that brought this one up. It certainly is interesting. If anything, just to look at it and see how expensive these stocks are getting, these stocks that are really, really small. All right. So Ben 10, you were looking at Poet the stock, yeah, we can take a look at that. I'll put it on the list, but again, it's going to be a little while before I get to it because I've got a list going. In the big house shoes, it's up because of NVIDIA. I get it. NVIDIA is kind of drumming up attention. It's trying to get like its ecosystem to really produce more products and solutions. So that way NVIDIA could sell more GPUs in the future. But just having NVIDIA kind of be a brand with your company, I mean, I just don't think that's all that impressive to me. I personally bought 2 GPUs back in 2017 for my son who wanted to mine Bitcoin. It didn't make us like anything special. We just bought GPUs. My son had a interesting kind of year of trying to mine Bitcoin. He learned a lot. Great. Mission accomplished. So if a business gets to go up 500% just by buying GPUs, that's just too much of a bubble for me. Anybody can buy GPUs. It doesn't take rocket science to do that. All right. So, yep, I'm right there with you, Mike. RR would not be a stock I would touch. And it would be a stock that I would watch just to see, is this another sign that we may be in an expensive market? And if we do have a correction, how far will this stock drop? It'll be a barometer of sorts to take a look at. All right, so Ben 10, that's how I feel about getting DraftKings. Yeah. I mean, DraftKings is a well-recognized stock. I've covered it a couple of times over the last couple of weeks. We can take a peek at it. It'd be very easy because I have a full valuation. I'll put it on the list, and we can look at it later. All right, let's keep moving. We're going to go to the next stock. It looked pretty interesting. It's a stock that does power systems. And the company is Power Solutions International, Inc., PSIX. Looking at their website, they do power systems, generators, and they do have products that are more durable. Like it'd be kind of a temporary power generation use case, but power generators their stocks are really going up. This one certainly has gone up in price. If you look at the 1 year, it's up 364%. The 5 years up 2,875%. Now, the story behind them is the data centers are going to need power, and all the businesses that produce, equipment that produces power, man, their stocks are flying up. Let's see what kind of fundamentals we have here. Now, this company, $2.22 billion in market cap, revenue, $597, net income, 110. PE ratio at 20, forward PE at 30. Analysts think it's really expensive. It's priced 61% too high. Let's take a look at their growth. The growth does look interesting in the trailing 12 months. We look at the quarterly, we see that we're really beginning to grow. So I would have to say that there is some excitement brewing here. Customers are buying their product, buying their, electricity producing machines at a higher rate. Now they were not flourishing back here, which, the AI build out kind of started 2023, 2024. So not a lot of growth there, but the trailing 12 months does look pretty darn impressive. Q2 looked really good. Q1 looked really good. Even Q4 of 2024, 37% growth is pretty positive. So that looks good. The growth looks really good for this business. Gross profit isn't very high. That's one thing that I would point out. Some of these industrial stocks, they're somewhat of like icons for the U.S. economy. You think about Caterpillar, you think about, these businesses that we know what they are. They've been around forever. but they don't make a lot of money. Okay. You have this business and they're at an all-time high for gross margins at 29. Gross margins of 29% are terrible. If you look at, these really valuable businesses like a Meta, or if you look at a Palantir is like 90% gross margins. That's why those businesses have such high valuations and are so desirable, is when they write their software, they don't have to put materials into the product. They don't have to hire a bunch of people to assemble and manufacture. Supply chains, they don't need supply chains. Where these guys, man, they have procurement organizations, they have manufacturing organizations within their company, they have engineers that have to engineer everything, industrial engineers. Man, these guys have a long list of things that they need to do. And at the end, to me, it's a less desirable business. It's not as lucrative as other industries. So that's one thing that I find it hard to warm up to these industrials. I get that they're caught up in the AI data center build out, but I'd rather invest in the semiconductor stocks that are making 85% margins, the software stocks, the hyperscalers, like, Google Cloud's probably going to make a fortune selling their infrastructure in the data center to those businesses that want to build out AI applications, use cases, and so forth. So that's enough said on the gross margin. You guys know my opinion there. The profit is pretty good. Again, they're hitting all-time highs, but they're never going to be anywhere near some of these more valuable businesses in the market. One thing that's showing up is, even though they are a sizable business, their cash flow is 10%. That's not very good. You look at other businesses, they could be 30%, much higher. But they do have some cash flow, $62 million. All right, so we looked at their cash flows. We looked at their margins. Let me take a look at their balance sheet and make sure that balance sheet's in good health. So they have $49 million of cash. Debt is at $148 million. So they have a net debt position of $98.9 million. I don't think that's too bad. No, it's 1.3. So long as debt to EBITDA is below 3, the balance sheet is acceptable. If you're near 0, the balance sheet is excellent. They're toward, the bottom end of that ratio. So the balance sheet's in good shape. Let's see what analysts are saying about this stock. So, well, I'd have to specify. We've got one analyst and he's thinking the stock's priced too high. Now, the stock has been going up really fast. Now, we've got a business that's fairly small, right? It's not like they're a gigantic business. And they're growing this year quite well, 29%. Now, 3 analysts are putting their information into this forecast. Now, if they grow at 2%, I went over the margins and how that's a limiting factor of the valuation of this business. But if they grow at 12% and their stock price has been climbing like crazy, I'm pretty sure I'm going to pass on this one. It's just not the right business for me. I'd rather buy businesses that make more money. But let's complete a valuation and kind of see where we're at with this company. I've got something set up already for them, but I need to update the numbers. So let's do that together here. And here is the model that I used, the template, but I got to update the numbers. All these numbers are not correct. So let's just start from the beginning. How many shares do we have outstanding for Power Solutions? We've got 23.03 million shares outstanding. Now to start working with some cash flow. What's the trailing 12 months of cash flow? And that is $62.23 million of free cash flow. And I'm going to grow that by the growth rate that I'm going to go with on this stock. And the growth rate is not going to be 15 because I showed you that the future growth is expected to be around 12. All right, so we have an intrinsic value, a present value of all those cash flows of 1.59 billion. That's discounted by 9%. I had already made a decision on 9% because these guys are a smaller business, higher risk. Now let's update the balance sheet items. We did have some cash on the balance sheet and we had some debt. So the cash was 49,460,000, and then we had debt of 148,360,000. So when it's all said and done, I think that each share is worth $64 if I take the value of cash flow I expect from this business. But the stock's trading at 96. So I'd have to pay a premium of 33%, and I'm not going to do that. Now let's take a look at earnings per share, see what that looks like, and see what kind of value comes out of the earnings per share number. It's expected in 2026 that they're going to do $4.04 in earnings per share. Now they're going to be growing, so I'm going to give them an 18. That's pretty generous because I told you about the margins. The margins are not good. And I'm going to be a little more generous there and go 15. So this business, if I wanted to be an investor, based on my research and valuation, I'd have to pay a 26% premium. And that's not what I do. I like finding great businesses and then buying at the right time. Buying at the right time might mean I have to wait. I have to wait for the right time. For example, NVIDIA, you could have bought it for less than $90 a share within the last 12 months, and that you would have more than doubled your money. So this business is priced too high. I would be chasing it and probably lose money if I buy at these high prices. So I'm going to wait. I don't know that I'm interested in this business to begin with. My appreciation or the desirability of this business is not very high. Their margins aren't good enough. So this one here would be a pass, a sell for me. I wouldn't really be interested. I'm not going to watch it a whole lot. I'll just let it do what it's going to do. But I wanted to do the analysis because an investor wanted me to do that, and mission accomplished. All right, let's move on to the next stock. And the next stock is going to be PGY. And that's Pagaya Technologies. And I've never looked at this stock. Pagaya Technologies, a product-focused technology company, deploys data science and proprietary artificial intelligence-powered technology for financial services and other service providers. Their customers and asset investors in the United States, Israel, and the Cayman Islands. The company develops and implements proprietary artificial intelligence technology related to software solutions to assist partners to originate loans and other assets. So it's technology, and they're focused on the financials industry. Let's take a look at their website. I always like to see kind of, just to confirm I understand what they're doing. So they're providing the infrastructure, the software, the systems to allow those that make loans be more efficient so they could establish credit worthiness and then be able to extend credit where that business would want it. So they're doing business with US Bank, Ally, SoFi, Visa, Ally. So that's what they're doing. Okay, I get that. So I understand their business. Now let's take a look at their fundamentals and see if we can assess how their fundamentals look and if this stock is a good investing idea or not. Okay, so we are looking at a $2.38 billion market cap company with revenues of $1.15 billion. So you're paying 2 times sales. Not bad. The stock is up nicely, 212%. Year to date, up 234%. Wow, look at that. So these guys IPO'd, what looks like they IPO'd back in 2022, which was a rough year to IPO, by the way. Stock market was selling off. And somehow it looks like there was some kind of excitement over this stock. It went up to $300 a share, but then it just came down. But the last year, the stock's really been moving. They have no PE ratio in the current year, but next year's PE ratio looks pretty rational at 10.62. And when we look at the growth rate, now the growth rate is good, but I like looking at like what's the stock been doing? Up 212%. All right. You're somewhat of a small company at 1.1 billion and the growth rate's 25%. That's not matching the excitement on the stock price is what I would deliver as a comment. Now, when they were tiny, they were growing really fast. And I think maybe that's what caught the market's attention is, wow, these guys are going to grow really fast. But then they slowed down and then now they're beginning to grow. That's a pretty good growth rate, but it's not setting any records. All right. So we've got a business that, let's take a look at their gross profit looks kind of low. Let's take a look at their margins. So if these guys are truly a software business, they should have margins of 70, 80, touching 90% if they're really, they have a very in-demand software where the company itself has a lot of pricing power. Man, they can get close to 90% margins. Just look at Palantir. This case here, no, this is not like up there. It's not up there with the big dogs in the industry. And therefore, they're not profitable this year. Trailing 12 months, not profitable. Next year, they're supposed to hit profitability. And also their gross margins are not really great. Now, you could say this is a smaller business. Yeah, a newer business. They're new to the markets 3 years, but this is a well kind of known area of the market. Financials, extending credit. These are not new concepts. So these numbers look okay, but I'm feeling like that stock price appreciation is looking like it's not matching the fundamentals at this point. We're going to do a valuation on this. So we'll see if my instincts, intuition is accurate or off. Cash on the balance sheet, 204 million. Debt, 763. And what's the debt to EBITDA? 3.8. So it's a little high. Now, I'm not going to freak out about it because they are a young business, but it is high. It's going to drive a higher discount rate because not only am I taking a risk on a small business, they have a balance sheet that just barely passes. It's kind of like a C minus. You got credit for the class, but you're not very proud of the grade. All right. Looking at the forecast, we've got 8 analysts that are covering this stock. Some of them think, man, this is a good company. It's worth $54 a share. And then we've got some that are like, hey, this stock is not priced right. It should be priced at $21. Together, on average, they think that this stock is discounted by 19.5%, based strictly on earnings per share. Earnings per share is growing nicely, and the earnings per share for next year does look good. Their revenue is going to continue to grow, and if they're successful in a couple of years, they'll be a $1.7 billion company growing at 12%. Now, the stock price is not going to flourish if they're growing at that rate and they're this size. Because when I compare them to other companies like DocuSign, which has way better margins, DocuSign's done okay, but it hasn't flourished as a stock. There's other stocks that are kind of have this kind of growth rate and size, and they haven't been flourishing. And again, those margins, they're a problem for me. I'm finding it hard to get over those low margins. Me, I love companies with high margins. And I love companies like Meta, Robinhood, Uber. They have fantastic margins and they continue to grow. All right. So let's get into a valuation since PGY is kind of a software play. I got plenty of software companies. Put these guys next to, and I'm thinking, and put them next to a company that everybody knows about, Intuit. Everybody knows TurboTax. Everybody knows QuickBooks. And maybe you've received an email that was sent through their MailChimp application. And Intuit's been a really successful company over a long period of time. And they're growing at about the same rate as this company we're looking at. There's a big difference. Intuit is massive. They're huge. And this company we're looking at is not. They're tiny. The other thing, if you look at Intuit's margins, they are really high. And the business we're looking at is not. That's why I'm like, kind of holding a higher standard because it's my money that's being invested, right? And I'd rather invest in a business that's going to make higher profits, be more successful versus maybe taking home a sick puppy that isn't ever going to flourish. Now, I like puppies, by the way. Maybe I should use a different analogy. All right, so we had a kind of a rough balance sheet with the small business. So I'm going to go with 9.5 as the discount rate. And we're going to look at the trailing 12 months of free cash flow. What is that number? That number is $115,150,000. So all right, we got that there. And the growth rate. So is it going to grow at 15%? Let's go with 12. It's going to be their longer term growth. All right, that looks good. Intrinsic value is $2.7 billion. Now we're going to add cash and take away debt so we could adjust those factors. And I like putting debt in there because you could have two similar businesses. And when I compared DraftKings, which came up earlier in the stream, versus their competitor, which was Flutter, I think one of the two had a lot more debt, but the other ratios were about the same. Well, I'd rather buy the business without the debt. And that's how I am able to put in debt level so they could be an element of the valuation itself. And then the debt was 763. All right. So shares outstanding for this business, they are 76 million shares outstanding. So once it's all said and done, this is a forecast that I think is good. It's going to probably land near these particular numbers as we look at a growth rate of this business. And a discount rate of 9.5, which is higher than just a small business because of that balance sheet being a little bit higher in debt. And I'm getting a value per share that's 9% lower than the current stock price. Okay, we covered that piece of the valuation. Now let's take a look at the earnings per share and see where the stock price is if we look at earnings per share. So I'm going to use next year's 2026 numbers. That's $1.66 per share. They are a growing business. Margins are not great. 25. No, I can't go 25. I'll go 18. And their growth rate is going to be good on the earnings per share line. So I'm going to go back to 24. So this business, based on earnings per share, I'm kind of agreeing with the analyst that had it roughly at around 20% discount. The earnings per share does look good. When I combine the two and there's more weight on the free cash flow method, there's a 13% discount. Now, I've got choices within software businesses, and I have a lot of choices that offer me much better discounts, 30%, 40%. And these are good businesses that are growing just as faster than these guys. So this one would be a pass. It would be a solid pass. And, their business is okay, but their margins are not good. I could show 10 software companies with much better margins, same amount of growth. And that's really what we're in. We're in a market. We're in a market for stocks. And these stocks, we can shop around and find the best ones, the ones we really want to own, and buy the ones we really want to own that have the terrific fundamentals, buy them at terrific prices, and make lots of money. That's the goal. And it's not buy a questionable one that has questionable metrics. No, I'd rather buy really good stocks. When you look at my list of software stocks, boy, man, I got software stocks coming out of my ears because I love software stocks. They make a lot of money. They grow like Microsoft's a software stock. It's over $3 trillion in market cap. Google produces a lot of software. They're knocking on the door of 3 trillion. I mean, I can go down the list of software success stories. So I like software a lot. So do I value a lot of companies that are software companies? Absolutely. I want to find the next great software business. So let me update my spreadsheet here. I want to make sure that I track this stock. I share this sheet of research with members of the channel, and you have to be an advanced member or higher. But I share it because I think they by 24/7 they can go look at research that I've completed, and I think it's a useful reference for them, and that's why I provide it. So I'm going to keep track of this valuation and see how it goes. All right, so that's all I need to do for now. Let's move on to the next stock. And the next stock we're going to do is Airbus. Airbus is the Boeing in Europe. And Airbus has been doing better than Boeing. Now, that's not saying much because Boeing has kind of been a basket case over here in the United States. They had so many problems. But look at these guys. Airbus, 65%, 5-year. Look at that chart. Way better than Boeing. Okay. Boeing was like, at certain times, it was like, geez, they had like the 737 issues where the design was not right. And then they were blaming it on the pilots. And that was terrible. And then they had other quality issues. I think a door flew off an airplane mid-flight. None of that happened with Airbus. And I fly quite a bit, and I've been on Airbus jets, and they're pretty darn good, man. They actually seem to be a little quieter than the Boeings. So there's a very good company. I think it's headquartered in Paris. It's actually it's saying that it's headquartered in the Netherlands. So I'm corrected on that. I thought they were headquartered in Paris, but Airbus is more of it's a company where multiple countries in Europe are participating in the manufacturing of airplanes. All right. So these guys are 184 billion. So we're talking with a good sized market cap company, revenue, 82 billion. We're dealing with US dollars. Earnings per share is really low this year. Next year, it's going to be a little higher. They pay a small dividend. Couple of things here. RSI, they're overbought. It's well above 50. And understood. I think Airbus produces commercial jets that we fly in when we take a trip. They also produce military aircraft or aircraft for the military. And as we know, in Europe, those countries are building up their armies. And that's been a big theme. And I think that's why these guys are catching a lot of investors. Let's take a look at their growth. So their growth is not overly exciting, 5% in the trailing 12 months. They were booming here. And the problem was, or I should say the situation was, when we got hit with COVID, right? Nobody was flying. Everybody was at home with a mask on, just waiting this COVID thing out. So we didn't need any more jets for a while. Well, over time, then we became more comfortable for travel. It started to grow, and then all of a sudden, everybody wanted to travel. So it's the airlines were ordering jets left and right. So that's where the boom in their growth was. But now they're beginning to slow down. So this is kind of moderate growth here. For a big company like them, $70 billion in euro, which is almost 1-to-1 with the dollar. That's pretty good growth, but that's what you get when you buy this really well-recognized business. It's got such high revenues. It's hard to be a high grower going forward. Now we're seeing that the gross profit isn't all that great. Let's go down to that line. That's one of the things that I don't like about aerospace. Aerospace tends to have low margins. So historically, we're going 14, 11, 18, 17, 15. So these are not awesome margins, right? And the profit margins are not awesome either. Single digit across the board. So it's interesting that the stock has flourished, but when you look under the hood, so to speak, and you look at how profitable is this business, not very profitable. Look at the free cash flow margins, 3.5. If you went to the bank and they said, hey, sell all your stocks and we'll pay you 3.5 yield on some bonds, you'd very quickly say, no, thank you. I'd rather keep my stocks and do 35% rate of appreciation in 2025 and 25% in 2024, 23% in 2023. That's the kind of rate of return we're looking for. And how are we going to get that if we're buying businesses that can barely make money, right? So that's what goes off in my head. That's why I have a preference for these other businesses that make lots of money versus businesses that make very little money. Now, moving along, this is a very well-recognized business. The one thing that I find that is kind of a double-edged sword, right? It's good that everybody knows what Airbus is about, but it's bad because then a lot of investors just buy it because they know what it is. Hey, I flew on several flights. I flew on the Airbus, very impressed with the aircraft. I'm comfortable owning the stock. So they get naturally some demand for their stock out of that type of awareness. Well, it's somebody else's investment. It's not mine. For example, I don't Broadcom. I own the Broadcom stock. I didn't use any of their chips in my life. A lot of the Broadcom chips are in data centers and so forth, but I personally have very little Broadcom that I'm aware of in my life. I think it's in mobile phones and stuff, but you don't see the brand all that often. A lot of people don't even know what Broadcom is. There's a lot of money to be made. Those guys make good margins, right? So somebody else could have the market awareness based on brands like Nike, and I'll take just the better fundamentals. That's my preference. All right, so let's get our pencils out. Let's get a new sheet of paper and let's value Airbus. What is this business worth? And what is this business worth to an investor of my type that looks at fundamentals, wants to buy a great business at a discount? There is no way I buy without it. At worst case, I buy a terrific business at fair value. But I'm not going to pay a premium on a great business. I'm not going to pay a premium on an okay business. So let's see where Airbus is going to land. I'm not sure what business I have that's similar to Airbus. So let's take a look. Airbus is an industrial stock. We got aerospace and defense up here. Got a couple. So let's go to TXT. I think TXT does have a pretty good aerospace business. So I'm going to look for that stock and then we'll copy that as a template. So Textron, here it is. All right. So since I've got a little space there, I'm going to put it above Textron. So All right, so there's Textron. We're good. And okay, the symbol I'm working with, and Airbus is a European company, and according to stock analysis, headquartered in the Netherlands. So I have to use a ticker that is the over-the-counter ticker. Now, 8% discount rate. Yeah, I'm fine with that. I've got no issue giving them a good credit rating. I didn't even look at their balance sheet, so I'm gonna come back to that in a few minutes. We saw that their growth rate was like 5%, so I'm gonna go with 6. All right. Now, free cash flow trailing 12 months plus growth. And what was their free cash flow? So this is going to be in euros, no big deal. We can deal with that. All right. And so free cash flow was $2,910,000,000. All right, we got that number there. We're going to grow this by 6%. Now, what kind of cash do we have on that balance sheet and how much debt? So they don't have much debt. Nicely done, Airbus. $14,100,000,000. Then we've got $15,680,000,000 of debt. How many shares do we have outstanding? All right, let me take a look. And that number we're going to go with and I think I got one of my commas off. Shares outstanding. And that is correct. Okay, good. All right, so as kind of expected, those low margins show up because the free cash flow shows up as a low number. And if I compare using a discount rate of 8%, which is fine, this is a well-recognized company, we're good. You have to pay a 60% premium to buy Airbus. No thanks. I'll fly as much often as I need to, but I'm not going to buy an airplane manufacturer like Airbus. Not with that kind of premium. And I haven't really been a big investor in aerospace because of those margins. I just I look at it, I'm like, why would I buy a business like that? All right, earnings per share this year, $6.25. And I think that's in euros. So I'm going to have to, what is the euro to US dollar conversion? So you have to pay $1.17 to buy 1 euro. So we will convert that on the fly here. Now this is they're growing at 8. Yeah, I guess so. And then we'll go with a 6 here. Okay, so we got that there. So on earnings per share, the earnings per share does drive a really nice valuation where the stock is discounted by 58. But it's this cash flow that I really focus on. And really Airbus, if you're a earnings per share investor, you probably really like the stock. But me, I'm more of a cash flow investor. I don't like the stock. This would be a pass for me. I can understand some people like buying these stocks, but not me. I guess I'm hooked on those high cash flow, high margin businesses. That's where I want to be. I want to be with the companies that make lots of money. So I'm going to pass on Airbus, leave it for somebody else to invest in if they'd like, because the stock has been appreciating nicely. It's gone up really, really well. Now, when we talk about, industries, and some industries I don't like investing in, I like to make the analogy that, everybody knows the restaurant business. And the restaurant business, when I was a youngster, I was a young man and I wanted to make a few bucks. I was in high school, so I worked at a restaurant. Boy, people in restaurants work hard. Total respect for what they do. But at the same time, they don't make a whole lot of money. Restaurants make very little margins. It's just a tough business. And you don't have businesses that are worth a whole lot of money on the stock exchange that are restaurants. And that's kind of an example of some industries are very desirable, other industries are not. And I'd rather go to the ones that are really desirable, that are going to be worth so much more in the future, to put my hard-earned money into and see that investment grow over time. So those will be my comments on industry. Let's move on to the next stock, which is BSX. So BSX is Boston Scientific. And these guys, I believe, are scientific med device healthcare. So they're doing healthcare products. I think a lot of, let's read the description. We'll go to the website. So Boston Scientific develops, manufactures, markets medical devices for the use in various interventional medical specialties worldwide. It operates in two segments: med surge and cardiovascular. Okay. All right. So here is their website. So they're probably doing pacemakers and these, I'm going to call them devices, machines that people will get implanted in order to live longer, healthier lives. All right. So this is a med device company. All right. We know what they do. Let's take a look at what the stock's been doing. We're going to value this company, probably compare it to Intuitive Surgical. All right. So this stock over the 1 year, it's doing okay, 14% year to date. It's not keeping up with the S&P, up 7.73. It has a PE ratio of 57, which is expensive. Forward P of 30. If they're growing, I'm good with that PE ratio. Market cap 142 billion. Revenue 18.5. Strong buy with a 26% discount. All right. So based on these P ratios, I want to see growth and I want to see margins. Am I going to get it? I got my growth, 21%. That's good growth. And I like the acceleration. Okay. We're going 6.6, 12, 17, 21. Hey, nicely done. Profit margins. So I think the margins are going to be good too. Margins are at 68%. Very good. This is a med device company, and they're not going to be as good as, a pure play pharmaceutical company, biotech company like a United Therapeutics or Catalyst Pharma. Those guys are at 75, 80% margins, 85% margins, because they have a formulation of a drug and the manufacturing cost is so low. These guys have to put out a product with materials and other things that have to be invested in that product in order to sell it. 68% is very good. So for a med device company, I think it's better than Intuitive Surgical. So that looks good. Free cash flow, 3.4 billion, and they've been growing it. Very good. So I like what I'm seeing. I like what I'm seeing here. So I've got good growth, good margins, free cash flow is growing. Show me a good balance sheet. You're on a roll. You're on a roll, Boston Scientific. So we got $500 million of cash, 12 billion of debt. How much EBITDA do we have to work with? 2.5. So we're good. We're not great, but we're good. If we were at a 3, it'd be like, you guys got to work on your balance sheet. they should work on their balance sheet, get it down to like 1.5, but it's very acceptable at 2.5. We're good there. And let's look at the forecast. So analysts on Boston Scientific, we've got 22 of them weighing in, putting in a price target, and they think it's on average discounted by 26%. The worst case scenario analyst actually has a price target above the current stock price. Not bad. Now we're looking at the forecast. We've got lots of analysts weighing in. Hey, I want to tell you what I think Boston Scientific's going to do. They're going to keep growing. Growth looks really good. They're a pretty good sized company, right? These are big numbers, 22 billion, 24 billion, 26 billion. So that's very good growth. So this is a good looking stock. And the profitability is going to grow a little faster than that revenue growth. Okay. All right. So I am liking the numbers. I am eager to see how this thing's going to value. All right. I'm thinking this thing's going to look pretty good. But let's put it in a model, right? We can't eyeball everything. We got to put the numbers to the test. And we are going to go look for Intuitive Surgical. Here's Intuitive Surgical, and Stryker's in here too. Look at that. All right. Those are both med device companies. I think Intuitive Surgical, they're not quite the same. It looks like Boston Scientific is manufacturing things that go in the body. Intuitive Surgical sells products that surgeons will use in surgery and so forth. I could have it wrong, but they're in the same industry, serving the same market. Okay, so let's take a look. So we've got today's date. PSIX. Okay. That's Boston Scientific. So I'm going to go 8.5, a little debt on that balance sheet. And now let's take a look at the free cash flow amounts. They look good. They were growing the free cash flow. And that number is $3,485,000,000. They were growing the top line by 21% the current year. They're going to keep that growth going. Now I'm going to go 17%, and that'll be my growth rate there. So the intrinsic value is going to be $117 million. Let's add cash and take away debt. Cash of $534 million, debt of $12 billion, $30 million. How many shares do we have outstanding? We have 1,480,000,000 shares outstanding, making their market cap 142 billion. So I'm coming up short. Boston Scientific is being priced 26% higher than the value of their free cash flows. And stock looks good. I mean, you can be more optimistic in the numbers if you were working with the model. Let's say we moved growth rate to 20%. That would help. But, I'd rather go with the numbers that I really do think. You can say, well, the balance sheet's no big deal. It's just a little bit of debt. Yeah, we can get it closer. But at the end of the day, we shouldn't be splitting hairs on investments. It should be a clear, hey, that's a really good opportunity. I'm going to invest because I think I could make 50% rate of return on that stock. And we find those situations. This one here may just not be setting up to be one of those situations. All right, so let's take a look at the earnings per share that we expect for for 2026. The number we expect is $3.43, growing nicely. I'm going to grow that by 12%. So it's fairly priced if we look at the earnings per share value using a PE at 25. They're growing nicely. They have good margins, so they deserve that. So this is priced above their intrinsic value. I wouldn't buy this stock. Am I like having to own a med device stock? No. I'll participate in healthcare, but I guess I like pharma more. I really like United Healthcare right now. I'll buy into healthcare, but I just will buy the stuff that I really like. Boston Scientific's been doing okay, but it's just the numbers are not on my side. So I would pass on this stock. And if it did have a really strong sell-off, maybe I would be interested if that was the case. But for now, I'm just going to leave my capital in my pocket and look for the next better opportunity. All right, let me just make a note that I want to come back and fill in the information for Boston Scientific. That way I can track this stock and members can look it up if they're interested in Boston Scientific. All right, we've covered 6 stocks to this point. We got more to go. So let's keep moving. So we handled Boston Scientific. Let's move on to the next one. Let me close some browsers here. Got to clean up my work area. All right. So what's the next stock here? We've got symbol ORI. ORI. Old Republic International. What do these guys do? So Old Republic International Corporation, through its subs, provides insurance underwriting and related services primarily in the U.S. and Canada. So they do specialty insurance, title insurance. Okay. Insurance company. I haven't heard these guys. So insurance, property, and casualty. They're out of Chicago. Maybe they're really popular in a region of the U.S., but I haven't heard of them in California. Okay. Maybe they do a lot of business there in Illinois and surrounding states. Okay, this is insurance. Insurance is a good industry. I like insurance. The 1 year on this stock, it's up 20%. Year to date, 18. 5 year. I mean, what's there not to like? The stock's getting it done. And if you look at Progressive, Allstate, and some others, they've been good investments. They've been doing quite well. This stock in particular, man, look at this. Over the last couple months, this thing's just been on a tear, going from $35 a share up to $43. That's a pretty good rate of return, up about 20%. So that looks good. This is a smaller cap stock. If you look at Allstate or Progressive, they're much bigger. This is $10 billion. And then the revenue is $8.67 billion. PE is nice and low. Looks good. Pays a dividend, 2.7. Nice investment for an older investor that wants that dividend and maybe is very familiar with this business. I'm not. I'm familiar with Allstate. I'm familiar with a couple of other insurance companies. These guys here, according to analysts, they're discounted a little bit. They are growing. They're growing nicely in the trailing 12 months, 14%. They're about an $8.6 billion revenue company. They did have a couple of tough years in 22, 23. I know in those years, so did Allstate have a rough year. And the reason for that is that insurance tends to be regulated at the state level, and you can't just raise your prices if your costs go up. You have to work with the regulator, the commissioner. At least in California, there's a commissioner, and you submit the data that shows that, hey, costs are really going up. We need to raise our prices or we can't insure people in your state. And then there's a partnership there, and they go, yeah, you can raise your prices, and then you can raise them. So there was a period of time when they had to adjust their rates, and they continue to adjust them higher because houses cost more, cars cost more, things cost more. So that's what's been happening there. But now insurance companies are making healthy profits. That's looking good. All right, so that looks good. The revenue looks good. And insurance companies, I tend to find really good, opportunities. And in this case here, the numbers are looking good so far. Profit margin of 10%. Bear with me. I'm going to turn the TV on because I think football game's been going on. Forgot about the football game. Got to keep an eye on those Rams and those 49ers. All right, and we got to go from regular TV to Amazon Prime. That's where it's at today, right? Bear with me, guys. Once I get my Prime video going, we'll be good to go. All right, so I'll let that kind of do its thing in the background. All right, so we've got good growth, profit margins. Okay. So they pay a $1.10 dividend per share. And I think they're going to give us the free cash flow per share, right? Shares outstanding. All right, I'll get that another way. Okay. All right, the forecast for this business, we've got only two analysts. This isn't a big insurance company. And the analysts are somewhat in agreement, right? One's at 45, one's at 47. The stock is trading at 42. So $7% discount available on the stock, according to these two analysts. The stock is going to grow revenues nicely. Or the company is going to grow revenues nicely, growing by 8.66% in 2025, and then 6.16% 26, 6% in 2027. The earnings per share is going to expand, not as much as revenue, by the way, but it is going to grow a little bit. Okay. And 4 analysts are contributing their research and analysis into this particular data set. Okay, so we're looking good there. Let's just take a peek at debt and make sure we don't have a big indebted business on our hands. And we don't. It's pretty close. Got 1.34 billion of cash, 1.59 billion of debt. So we are looking okay on debt to cash. All right, so Old Republic, what is it worth? And I've got a couple of examples to compare against. So let's get into a quick valuation on this insurance company. What I'll do is I'll compare it to Allstate. Allstate is a stock that I own. And these guys, let's take a look at this smaller business. I'm going to make some room and then copy the model. All right, so switching things up a little bit, trying to get the football game on. And then I'll be a happy camper doing 2 things that I love to do: analyzing stocks, hanging out with you guys, and watching U.S. American football, especially the Rams 49ers. I believe they both have good records to this point. The Rams have 1 loss. The Niners, I don't think have lost, but I was watching Polymarket, or I was viewing Polymarket, and it said that the Rams are 80% favorite, or 80% probability the Rams are going to win. So we'll see what happens. All right. So I made some room here for us to analyze Old Republic Insurance. Looks good. The symbol was ORI. All right, so Old Republic Insurance. Let's take a look at their fundamentals, look at their free cash flow, and then we'll look at other factors. So this company, free cash flow was 3.4 billion. They've grown it nicely over the last couple of years. And so 3,485,000,000, and then we're going to grow it by a little bit. So that'll set up the forecast there. This is a smaller company, so I'm going to go with the 9% discount rate because, you know, I could buy Progressive, I could buy Allstate. Why do I need to take a chance on a business that's smaller? I'd rather get a higher rate of return if I am going to buy a smaller player in insurance. So I'm going to raise that up a bit. Get rid of this kind of side analysis that I had on Allstate. Get rid of that. Okay, so we've got that going. Now on a growth rate, the revenues are growing by 21%. So that's good growth rate. And then the forecast, what was the forecasted growth here? So the forecasted growth is next year they're going to grow by 11, 10, and 9. So let me work with that. All right, so we'll go with 11% growth. Gives me this intrinsic value. Now let's update cash and debt. Shares outstanding for the company. There are 1,480,000,000 shares outstanding. All right, so there's about a 15% discount available on this stock. If I model it and look at the value of their cash flows, take away that debt, I get to a 15% discount. Let's take a look at the earnings per share that is being forecasted for 2026. That's $3.43. This is a growing insurance company. Looks good. And then it's supposed to grow by 12%. So I'm going to go with 11. So it's a good looking company. It's smaller, 24% discount, but you know, I have choices. Allstate is discounted by 49%. They crank out a lot more cash than this business. It's a very well-known company, good balance sheet. That name recognition just is a lower risk to me. So I think Old Republic is a good looking stock. Maybe we go to 8.5. That could make it look better, but since I'm not familiar with it, I'm going to use a 9. So that's the valuation on Old Republic Insurance. It looks like, you know, the insurance business right now looks good. And insurance is the business that Warren Buffett has made so much money in. He likes insurance because insurance tends to be profitable. They tend to have a way of using the cash that is provided by investors, you know, to make more money. And that is something that I'm interested in. All right, so let me update my watch list, and let me just pop this company into the insurance section of this sheet here. I'll put them underneath Progressive, and we'll be good to go. So ORI. All right, we got that there. And one more number. Okay, and I'll come back and update that later. All right, let me check the chat, see how things are going on the chat. I think I'm behind a bit. A lot of comments. Hey, everybody. Thanks for hanging in there. I've got a long list of stocks to take a look at. All right. So I think I left off here. Thanks for watching that energy video. Interesting. Yeah. I think energy does have potential. But man, if oil prices move, that's where the space moves. So we'll see what happens. And you like the market comparisons? Cool. Very good. You're in the bus, Shadow Guy in San Jose. Very cool. Okay. So I'll scratch out Poet. Thanks for letting me know. Appreciate that. Good to see you, Ben 10. So Big House. I've worked in aerospace my whole life. There's way, way, way too many expenses. Yeah, it's showing up in the margins. And that's what it's about for me. Good to see you, Brandon. Thanks for asking about Boston Scientific. So if you're talking about Penn State University, man, that was a disappointing loss that they had against Oregon. Or maybe I think you're talking about Penn State University. So not a stock, but that was disappointing. I'll leave it at that. And I think if you're going to be a contender in college football, you got to beat the good teams, and they just didn't do it. Ben 10, Nebius just keeps going up. It doesn't go down. Whoever's in Nebius, right? You're making money hand over fist. Look at that. 564. Ridiculous. Incredible. But we will see how this ends. I mean, this is a small cap, 31 billion. It's getting contracts. It shifted from being a Bitcoin miner over to being a premium hyperscaler, and it's figuring things out. It is beginning to grow, but I just think it's very risky, and I'm staying out of Nebius. I'm in plenty of hyperscalers. I own Amazon, AWS is the biggest, Google Cloud. I own others like Alibaba. If there, in fact, is going to be a long-term huge benefit to hyperscalers, I'm going to be just fine. If it's not, the businesses I own are very well capitalized. They have other businesses to lean on, and I'm going to be fine. I don't want to buy a pure play hyperscaler because if the demand for those services go away, Nebius, CoreWeave, they're toast. It's just going to be ugly. But for now, the party rages on. Congratulations if you're in this stock. I hope you've made a ton of money, and congratulations. All right. So is that Archer aviation? That's what I was thinking. So these guys are just up 4%, up 242%. So that's interesting that year to date, it's only at 4%. I guess a lot of the rise came at the end of last year. Look at that 5-year, you're only up 0.3%. Interesting. Man, Alibaba. I love Alibaba. It's one of my big positions, and glad for it. 123.67. And these guys, you see Nebius, these guys have a big cloud business. And if you consider all those companies in Asia that want to have AI, they are probably going to develop on Alibaba. And it also includes companies like in the Middle East and other places where they want lower cost compute. Alibaba has a great proposition for those customers. So Alibaba is a really, really good position for me. I bought it at the right times. I think I'm going to do great with it. I think this stock's going to 300, and I'm going to take it for a ride. Now, it's not the Nebius ride that's going up 568% a year, but it's a pretty fun ride. It's a well capitalized business with e-commerce, fintech. It's growing its cloud business really, really fast. So, and I get diversification into Asia at the same time. So that's where we're at with Alibaba. All right. So I got through the list. I think somebody asked about DraftKings. So let me take a 5-minute break, and then I'm going to come back to you guys. And let me put up a little banner here. And if you guys want to see some other stocks, now's the time to think about it and put them in the chat. Let me know. Yeah, buying at the right time is vital. I agree. So I'm going to take a 5-minute break. I'll be right back. All right, I am back. Let's get rid of this banner. Break is over. I got the football game back, or I should say on. Looks like the Niners are ahead of the Rams as I speak. And looks like Ben 10, you would like to take a look at ITUB. What is that stock? ITUB. So these guys provide various financial products and services to personal and corporate customers in Brazil and internationally. They do retail banking, wholesale banking activities with the market. So financial services. They are a pretty big cap, 71 billion, $24 billion of revenue. PEs look good. These guys are a bank. Okay. So big dividend of 6%. Analysts think it's that stock's gone too high. Stock is up 20% over the 1 year, 57% over the year to date, and up nicely over the 5 year. Wow, real nice. Okay. Now what's going on? So this is a bank, so I don't use free cash flow. I'm going to look at book value and their earnings per share. So net interest income has been kind of all over the place. Brazil does have a lot of currency devaluation for their currencies. So I think that causes some wacky interest rates and a lot of wacky numbers for comparisons. And these guys, so looks like the net interest income really went down the trailing 12 months. So revenues before loans, okay. Before loan losses, excuse me. So loan losses. So you see the revenue growth overall, not very exciting, 9% growth. The full year 2024, but the trailing 12 months, there is no growth. Okay. All right. Earnings per share has been expanding year over year. Looks good. So if I paid 10 times earnings per share, I'd pay $40 a share. They are priced pretty low, $7 a share. So analysts think it's, and maybe that was in a different currency because that seems like a really high earnings per share number. And I am dealing with U.S. currency. Okay. Two analysts cover the stock. They think it's priced a little expensively. They're supposed to continue to grow. Not so fast, but continue to grow. And earnings per share is going to expand nicely. Forward PE. So what isn't making sense is, okay, yeah, the currency is the Brazilian currency. That's why the earnings per share was so high. Okay. So this bank here, I mean, it's doing well down in Brazil. I'm not investing in Brazil a whole lot. I think I'm a little worried about how the fluctuations in currency are happening. And this one here, I would stay away from. It's a bank. I have good options here. I've been doing great with Citibank. And this is probably not a stock that I would go with. Let's look at their book value and see if their book value is growing. If you're comfortable with Brazil, this seems like a good stock. Book value has been growing. You want to see this. The book value is, in essence, the value of the bank has been expanding. That looks really good. Looks really, really good. So I just wouldn't want to buy a bank in Brazil. I don't know how you feel about it, but All right. The other stocks that you had out there, Siri, SIRI. So Sirius XM. How are these guys doing? Flat, down. So these guys, I mean, this is kind of satellite radio, right? $7.6 billion in market cap. Are they growing? No, they're contracting. Okay. Yeah, I don't know if has a big future because everything's on an internet connection now, right? I listen to Spotify, I listen to also music on Google. And I don't know how many people are going to subscribe to XM, right? But their market cap 7.6 billion, revenues are higher than the market cap, forward P is super low, they pay a high dividend. This is could be a value trap. What's the forecast? Let's see here. 12 analysts cover it. And one analyst thinks, man, you can double your money on this stock. The opposite end of that isn't too far down, $18 per share. So the downside isn't too bad. On average, it's discounted about 19.47. Somehow they're going to start to grow in a couple years. And they've been very flat. So this is not a exciting business. This is kind of a business you can buy at a discount and maybe make a modest appreciation and pick up that dividend. So I wonder who subscribes and what their subscribers look like, but this isn't quite like cable where cable companies are just losing so much money. And they're losing a lot of subscribers, and they're losing them to like Netflix, and they're losing them to YouTube and so forth. I'm not sure if that is the same situation with Sirius XM, but it just doesn't seem like a service that a lot of people are excited about or are interested in being a subscriber for. I think they're probably on Apple Music or Spotify or even YouTube, which has a lot of music options. And then you've got APLD. What's APLD? Applied Digital. What do these guys do? So Applied Digital designs, develops, operates digital infrastructure solutions to high performance computing, artificial intelligence industries in North America. They do data center hosting and HPC hosting business. Okay. So these guys are probably going up a lot. Yep. Wow. And look at that. They went real high, came down, and are back to going really high. Looks impressive. $7 billion market cap, and they're up 227%. So revenue is $144 million. So you're paying quite a bit for the company. You're paying, I'm going to say about 40 to 50 times revenue for the company. And they're not growing a ton in the trailing 12 months. So what am I missing? So why are they not growing? So they're slowing down their growth. So that would be a concern. Their price is a high growth company, but if they stop growing, that's a problem. Gross profit's okay. It's not great because let's look at their margin here. Gross margin, 29%. That's, I think, because they operate the data center. It's not like Nebius or CoreWeave. They actually are providing the service and they are getting a better margin. These guys are providing the space and they're not quite as profitable. So they're participating in the rally, but they don't participate in the profits, FYI. And these guys used to do applied blockchain. So a lot of these companies that kind of started with, hey, let's mine Bitcoin, are switching over to doing hyperscaler services for AI. Can't blame them. There's more money there right now. So that's what's going on. Applied Digital. All right. Hey, Ignacio, good to see you. You're a new member. So I do have an opinion on New. Let's take a look. So New Holdings, right? So New Holdings had a good earnings. Let's see what they're doing for the last month. They had a good earnings and they rallied. Now they're kind of settling down. Year to date, up 47%. For the 1 year, only up 13%. So it's been a very volatile stock. They're a $73 billion market cap company, very similar to this bank, right? But New Holdings is more a fintech play. They're not a bank, actually, digital banking platform. So they do credit cards. So I always think of them as more of a payment platform. And they operate new banks. So they are like a SoFi. They're a bank. And the way I value New Holdings is very much like I value SoFi. Let's take a look at how these guys are growing, and then we'll get to their valuation. Now, I owned New Holdings, and I decided to sell my stock because I just didn't have the confidence in this company. I'm a little nervous about Brazil. I'm trying to de-risk a little bit off my portfolio and kind of really keep a lot of these gains that I have in 2025. This was one of the stocks that I decided is going off the board, and I took them out of my portfolio. So these guys, and it looks like they just applied for a license in the US. Interesting. And New Holdings, it's probably a brand that a lot of Hispanics have heard of. And I know that Banco Popular is in the States, and that's a Mexican bank. So maybe that's the angle, because there are a lot of Spanish speakers in states like California, Arizona, Texas, and other states. All right. So back to New Holdings. So these guys on their growth is good. Their earnings were good. So they've just been a solid grower, similar to SoFi. And SoFi might be growing a little faster than the trailing 12 months. The book value, and I'm looking at the wrong financial statement for that. I should look at the balance sheet, take a look at the book value. Since this is a bank, we got to look at the book value, make sure it's growing. And these guys have been growing their book value nicely. Okay, so that looks really good. And their earnings per share, let's look at the forecast. We've got 10 analysts covering New Holdings, with the best price target being at 19 and the most concerning one being at 11. So this analyst thinks that the stock's priced too high. Discount of 7.5 if you look at the consensus. They're going to continue to grow. And I don't know where this number is coming from, because they're not growing that fast in the current year. And their profit is going to expand. So this stock's going to continue to work, but I think that the limiting factor when we invest outside the US is how confident will investors be to buy a stock in another country. And this one here has had its moments, but it's also had its really big sell-offs. So that's something to be aware of with New Holdings. Now, I think I have New Holdings as a valuation, and I know I'm pretty sure that I updated my valuation after they announced their earnings. So overall, I think this stock is discounted by 37%. If we look at the earnings per share valuation, and it's a pretty solid business. I mean, I know what they do. I like their growth. I'm just not comfortable investing in Brazil right now, as mentioned earlier with the other bank. But those are my opinions on New Holdings. I made a little bit of money on owning their stock. Is it going to be like a big appreciating stock in the future? It could be, but it could also really sell off. The stock, if you look at its history, just look at the 1 year, you have nice appreciating runs, and then boom, it sells off. It appreciates, it sells off, appreciates, sells off. So if they could have a better long-term chart, that'd be good for everybody. But it's an international stock. It's a lesser known commodity here in the States. So this one here is always going to have a little bit more uh, volatility versus owning an American bank like a SoFi. Even SoFi has a lot of volatility though. So that's what you're signing up for when you sign up with New Holdings. So thanks for asking, and thanks for being a member. Pedro Miguel. Yep, we certainly do. All right. So Warren Buffett, I think, sold. So Warren Buffett did invest in New Holdings, and he sold his position. So just be aware of that. Let's see. I've got Warren Buffett's portfolio. We can look at it really quick. So there's Nucor. That's not what we're looking for. Oh, there it is. I guess he's still in it. So Warren Buffett's still in it. He has $195 million. But hold on a second. So that's row 49. Yeah, Warren Buffett's still in it. So you are correct, sir. Warren Buffett's an investor in New Holdings. So that's a confidence builder there. I just decided to get out of it. SoFi is a little more expensive, and it's priced a little too high if I value it based on earnings per share. So thanks for asking about that. Yeah, I thought he sold them earlier this year, but I just looked at his portfolio. Let me do a double check there. So here's New Holdings. Yeah, Warren Buffett's not in them right now. So he was in them and then he sold them. Chase Coleman's in them. This guy's either number one or number two in the ranks right now for 2025 with the best return. So that's some pretty good company for New Holdings. But Warren Buffett did sell them. That's what I thought I remember seeing. So glad we confirmed that. All right. So yeah, and Warren Buffett's in Siri. Like Warren Buffett, he's a freaking genius, right? But there are some holdings that he has that are like, they're just not investments I would make. He's kind of really old school. So, all right, guys. So I'm going to wrap it up. I'm beginning to get fatigued and I'm hungry, so I better go. But I had a great time. I hope you found the stream interesting. I really appreciate you guys tuning in. And please keep the suggestions on stocks to analyze coming. For all the members out there, thanks so much. It's great to have you as members. Hopefully you're enjoying the videos I'm creating just for members. And I'm trying to put a lot of effort into those videos, making them high quality and making them a little bit longer, just really sharing a lot of what I think is interesting research on them and analysis. So hopefully you find that interesting. For that, it's Thursday night, so I'm probably going to stream tomorrow, and I'll probably stream in the morning. If you're up for it, look me up, and I'll be streaming in the morning. And if I don't get to see you on that stream, have a terrific weekend. I'll also stream on the weekends. I'll probably stream on Saturday in the afternoon. And if you're around, it'd be great to see you then too. So everybody have a great night. Enjoy the football game. And thanks for tuning in.